All right, well, thank you. Can everybody hear me? Thank you very much for having us here. I first met Daniel last year. I came to Ottawa. We were sponsoring an event for advisors, and we first spoke, and I could see at that time he was really, passionate about Vanguard and bringing this advisory service that at this point we don't have in Canada. What we are thrilled to do is share with you a little bit about how we're thinking about the markets and some key focus areas for investors. I actually loved the theme of the event, which was investments and financial planning. We think they're very much integrated and important, often maybe too much focus on the investment side, where we think most of what, as I'll talk about later, we think is really going to make a difference for retirement investors broadly, is more on the financial planning area. I'll talk about that a bit. But I wanted to also spend just a few minutes talking about Vanguard. I know Satwick's been chatting with many members of your constituent today. And I would just say, one of the interesting things about our company, and it very much, I would reflect back to the comments that were made by the prior speaker on this idea of acting in the client's best interest. One of the things about Vanguard is we are, in fact, a mutual. So I have to preface this by saying it's actually the U.S. shareholders, the U.S. fund holders that own Vanguard in the end. But at the end of the day, we are owned by essentially the investors that invest their assets to us. So for us, this has always been, a very natural question of acting in our client's best interest, because at the end of the day, they are indeed our owners. So we don't have essentially two masters to serve. Our mission is really to give people the best chance for investment success, treat them fairly, and we think there's actually four main principles that I'll touch on at the end that will help ultimately help investors achieve that objective. So as I said, we'll spend a bit of time talking about the financial markets, investing. That'll be the first part, and then more when you're working with, let's say, an advisor or even doing investment management yourself, what are some key things we think will help you along the way? So my first slide actually came out of a study we did years ago, about 5 years ago, and it was essentially looking at, what are the factors that drive equity returns over, short-term periods, one-year periods, out to longer-term periods, 10-year periods. And what I would say is there's often maybe too much focus on things like economic growth or corporate profits, things that ultimately we found to have very low explanatory power. And this, if you're following along on the chart, this would be the right-hand side of the chart, where you can see essentially those low bars mean that there's essentially very little explanatory power to those two variables. And that may seem counterintuitive. So you would think, for example, if there's faster growth in an economy, you would expect equity returns to be higher. If a company is more profitable, you would expect it to have higher returns. The reason those two things actually have very low explanatory power is not that they're not important. It's that because they're used by essentially market participants to value the market, essentially collectively, they actually have very low explanatory power. So we say, it's not, let's say, growth that matters. It's what's the price paid for growth. And essentially, how we come to that conclusion is following this chart all the way to the left, where you're looking at, and I won't go through all of them, different indicators that would, essentially explain stock returns. When you get all the way to the left, you end up with what's called a Shiller PE ratio. So this is essentially the current price of the market divided by 10 years of inflation-adjusted earnings. And we found this to have the highest explanatory power when it comes to actually forecasting equity returns. Now, what's interesting about that is you still only get to about 43% explained. So, there's still, with equities, always going to be at least 50% of the equation that's unexplained. That's essentially why people are rewarded for investing in equities. There's an equity risk premium because there's a higher degree of uncertainty. But the key that I would try and get across with this is really that we think ultimately, if you're trying to figure out directionally where the market's headed, or whether or not valuations, or whether or not, returns are higher or lower than you might expect, you really want to look at the valuations of the market. And we've recently done some work on this. For those of you who subscribe to the Journal of Portfolio Management, which those of you who are not familiar with it, it's essentially a journal in the industry where academics and practitioners can publish their work. We have a new paper. It's going to be in, if not the next issue, the one after that, essentially trying to answer the question, is the market overvalued? This is a question that long the industry has been contemplating since the essentially run-up in equities we've seen since the depths of the crisis. And from this chart, what we're showing is essentially that blue line would be this cyclically adjusted PE measure that I mentioned. The green line is essentially looking at where would you expect that to be based on the current macro environment. And by that, we're essentially adjusting this measure by bond yields. So essentially, when bond yields are high, you would expect it to be at lower levels. When bond yields are at lower levels, you would expect it to be at higher levels. And so by that, you can come up with what's the range you would expect that measure to be in through time. If you go back, you see the blue part where it's really shooting outside the fair value measure. That's really the tech stock bear market. So when we had essentially a bubble in the equity markets in the US driven by essentially a run-up in technology stocks back around 2000. You can see for us that looks like a bubble. If you look at today's market, it's above where historical averages or slightly above even where you would expect it to be based on this fair value measure, but we don't feel like it's in a bubble territory. So that's just to say we think returns are likely to be lower going forward because this measure is above its average and above where this adjustment measure is. But we don't view the U.S. market in a bubble scenario. Having said that, since we had the election last year, returns have been very positive based on things like corporate tax reform, infrastructure, and so forth that have yet to really be materialized. So, we think, in a sense, more could have been priced in the run-up than we're actually in for. And if that's the case, then that means we could at some point see a correction in the market, but we don't view that because there's a bubble in the market. So hopefully that provides our view on the U.S. equity market, which is, at least in the industry, a bit of a hot topic in the moment. And as I said, it's a somewhat nuanced view in that we don't think we're in a bubble, but at some point we think there could be a correction because, essentially we've had very high run-up in the market when these valuations have been at higher levels. And, at some point, we think the market ultimately comes back to its fundamentals. Now, if you look at Canada, which is really the right-hand part of the chart, essentially it's a different story there, still within its fair value level, but more at the lower end. So Canada being in a different place than the U.S., all else equal, you might think the Canadian market would outperform the U.S. market based on this. But the second part of what I would say about equities is, we always display our outlooks for the equity market in a distributional framework. And I'm not sure how many of you have read the book Super Forecasters, where essentially they looked at, what is really the characteristics of people that are good at forecasting. I won't go through all of them, but one of them is they always look at things in probabilities. So, as I said, even the best indicators we have for the equity market leave a large share of the returns unexplained. And so we try and recognize that in our forecast by showing a distribution. So essentially, global equity returns have been about 9% historically. If you look at our outlook, you see the central tendency is lower than that, more in the 6 to 9% range. But we're recognizing, a fairly significant number of observations that we could get returns above or below. So in other words, we try not to be overconfident in our forecast, but essentially when it comes to the next piece, which would be the financial planning piece, we think people directionally should expect returns to be lower going forward that means a few other things will be important when we get to that section of the presentation. A lot of it having to do with savings and costs would be, what we would view as two reasonable takeaways from this equity market outlook. Now, when it comes to the bond markets, you may have seen this chart before, essentially looking at bond yields falling from very high levels in the 1970s, 1980s to much lower levels today. The 10-year U.S. Treasury is around 2.34%, the Canadian 10-year around 2%. Now, you may have seen this chart before, starting, as I said, in the 1970s and 80s to today. And if you really just look at the right-hand part of the chart, directionally it just looks like yields have come from a very high level, and at some point they're going to bounce back. That old mean reversion thought kicks in. We essentially like to look at a much longer series, and the simple point that we would try and make regarding bond yields is that we actually think they could stay below 4% for the foreseeable future, let's going out 5-10 years, as they have in prior periods. So as I say, if you look at the last 30 years, the anomaly clearly looks like today, where we have very low yields. If you look going back to 1900, you see that actually yields can stay at 4% or below for long periods of time. Essentially what that means is you need to think about what would push yields higher. And when you think about the low levels of growth and inflation we see, as well as maybe even some headwinds to inflation, like developments in technology and so forth, we think that'll keep yields at relatively low levels. So in other words, we don't view a marked rise in longer-term yields, even though we think shorter-term yields will rise. Now, having said that, when you think about the outlook for the bond market, we would also expect lower than average returns. Bonds are a bit more predictable than equities. So if you look at the chart that we're showing here, essentially we're looking at what's the relationship between the initial yield on a bond portfolio and its 10-year return. And you can see there's a pretty strong correlation there. So depending on the part of the bond market you're looking at, yields are around 2 to 3%. That would give us a fair degree of confidence that returns will be in the 2 to 3% range for fixed income going forward. There's a small amount of possibilities that you could see returns above or below that, but as I said, the relationship is much stronger there. So having said that, the second major question I would say we're getting from clients, aside from is the equity market overvalued, would be why hold bonds? So if you have a situation where returns are low in an asset class, why would you really hold them? And for us, it gets back to, essentially, why would you hold bonds in the first place? There's an equity risk premium that we've seen that you could justify empirically and theoretically. The only reason we think you really hold bonds is to reduce risk relative to riskier asset classes. So we're trying to really illustrate that in this chart by showing, let's say, when equities are in their worst decile. So, one way to think about it, take all the equity returns we've seen historically and divide them into 10% increments. You look at the worst periods for equities. That's ultimately when we think you really need some ballast in your portfolio. And then we're just looking at what's been the performance of various asset classes. And, asset classes that you see being held out maybe as a substitute for high-quality fixed income, such as high-yield bonds or emerging market bonds, dividend-paying equities. You see in this chart, they all tend to fall when equities fall. So our view is that, high-quality bonds, when I'm talking about that, I mean investment-grade corporate bonds and government bonds, we think have just as strong a role today as ever. And it's also a bit of a paradox in that if you think returns are likely to be lower and there's a possibility we could see at some point a correction in the equity market, we think that's really a signal that you want to have some high quality bond exposure in your portfolio if that event comes about. So that's my update on the markets. As I said, I'm only going to spend about half the time there. And then I just want to spend a few minutes going through, given this, when it comes to financial planning, when it comes to building portfolios for retirement or frankly other purposes, what are some key areas that investors can have control over, first off, but also, in an environment where we have, some uncertainty, they're going to actually be positively associated with investment success regardless of what happens in the markets. So the first one would be costs. And, one way I'm trying to illustrate this is I talked about our outlook being one in which we think returns are likely to be lower. Think about this, start in the right-hand side of the chart, and just looking at, what essentially is the percent of return going to fees at various hypothetical returns. I'll tell you, over the last 30 years, the equity and bond markets have delivered somewhere between an 8 to 9% return. The two higher bars in this chart are really looking at 100 basis points and 150 basis point fees. And you can see at 8 to 9% returns, they're somewhere around, let's say, 20% of the return going to fees. If you think about today, as I say, where the outlook for a balanced portfolio after you take even inflation off it is more around, let's say, at a median 3%. Now, all of a sudden, 1% is a third of the return, 150 basis points, 1.5% is half of the return. So that's just to say, when it comes to planning, we think keeping costs low is going to be more important going forward than it has been in the past. The second part would really be focusing on your asset mix. We think one of the most important things investors can do, aside from using low-cost investments, is focusing on their asset mix. First and foremost, because it tends to define the spectrum of returns. In other words, we're looking at in this chart what's the highest and lowest return we've seen at various asset mixes through time. And you can see clearly bonds help truncate the distribution and give you less drawdown risk through time, and that gets back to the nature of high quality bonds. Let's say you have a diversified portfolio, 60-40, and then part of even the fixed income is diluted through less high quality bonds. That's essentially moving you to the right of this chart and more possibility for risk. So we think checking to see the amount of high quality bonds in a portfolio and really focusing on asset allocation is going to be very important. Two well-known academic studies essentially say 86% of a portfolio's return in terms of its variability can be determined by just the equity bond mix. This was a study by an academic by the name of Brinson back in the 1980s. And then we've essentially copied that work or build on it to show that not only is that true, but if you compare the average active balance fund to a low-cost index, actually you get more than 100% of the return. So in other words, the asset mix tends to have very high explanatory power in terms of not only the risk of the portfolio, but also the return. And I'll just spend a few minutes on the cost point again, and tie it into the asset allocation, and that, we talked, and our first speaker talked a lot about essentially ETFs and low-cost indexes. For us, it's not necessarily index passive. We're a big believer in indexing. That's the biggest form of low-cost investing. But the reason that index funds work is essentially because of what I'm showing you on the chart, which is essentially for any market, whether we're talking about the equity market, the bond market, 50% of the assets are going to outperform the market average, the index, 50% are going to underperform before you take fees into account. Once you take fees into account, the whole distribution shifts to the left, and at the end of the day, less than half of the assets after expense ratios, commissions, taxes, bid-ask spreads, all these things, less than 50% of the assets mathematically can outperform the market average. They call this the zero-sum game. And essentially then why index funds are highly effective is the idea that if you can earn the average return of the market, in other words, that black line, at a low fee, you stand a good chance of outperforming the majority of assets in a market. Typically, it's been around 2/3 of mutual funds would be outperformed by their indexes. The only nuance to this, I'd say, for us is, it can be done with active funds as well. provided that they're low cost. So for us, it's just, mathematically, costs come out of return dollar for dollar, and by lowering costs, you're increasing your odds of better performance. And as I said, particularly in an environment where returns are likely to be lower. This is looking at a study. I would say the third thing I'll mention around things we're hearing is maybe ETFs, index, low-cost investing is too simplistic in an environment where we have lower returns, and the idea that maybe alternative investments would be a better bet, essentially. And the way that we've tried to analyze this is by looking at the Nakubo Common Fund Study of Endowments. And essentially what this is a study of all the university endowments in the US, where about 60% of the assets are invested in alternative investments. And we've just tried to ask the question, if we created a very simple 60-40 portfolio of essentially index funds and ETFs, how would that compare relative to these more sophisticated investors that are using alternative investments? And believe it or not, what you see is over the past 3, 5, and 10 years, it's only been the very largest endowments that were able to best these low-cost traditional portfolios. Those endowments, on average, had more than $1 billion in assets, investment teams of about 30 individuals, and you could argue unique access to the managers that delivered those returns. And so, for us, it's just to say that we think traditional diversification can be highly effective relative to more sophisticated strategies. We like to say, low-cost indexing is outwardly simple but inwardly sophisticated, in that essentially you're owning all the assets in a market at a low cost based on highly sophisticated counterparties that are pricing those assets to come up with their weights. And we view that as a sophisticated strategy, even though it's very simple, and we think the power then is in the simplicity. So I have one final chart, and then I'll wrap up, which is something we're increasingly focused on at Vanguard, which is this idea of investor behavior. And essentially, what you're looking at in this chart is what is the average return of various investment categories of mutual funds and ETFs relative to the actual dollars invested in those funds. And what you see by category is that investors tend to trail the mutual funds they're invested in by, on average, 1 to 2%. And there's a relationship even between the likelihood that these categories are used more tactically, such as sectors and alternatives and so forth, and the magnitude of this underperformance. And so essentially the reason for this is it relates to a consumer decision-making process. If I want to go on a trip or book a hotel, go to a restaurant, I essentially type in to Google, whatever it is I'm interested in, and the word review or rating. I get some kind of star rating that tells me essentially out of 5 how likely I am to enjoy this thing, and I actually have pretty good experience with that. So in other words, if something's highly rated, I'm likely to enjoy it. And people naturally have developed that consumer decision-making process. The problem is that that works almost everywhere except investing, in that odds are if something's done extremely well, at some point it's gonna revert back to a more reasonable return. And so unfortunately what we see is people tend to buy on strength, sell on weakness. That essentially means they tend to sell at the top, buy at the bottom, or I'm sorry, the opposite, buy at the top, sell at the bottom, and that essentially leads to this behavior gap. So in terms of things investors we think should be focused on, and also advisors working with investors, this is something we're doing more and more research on. The piece of work that I just referenced that this came from was essentially called Right Mindset, Wrong Market, and just getting to the idea of this consumer decision-making process works almost everywhere but with investing. So I have just 4 things to talk about, but before I do that, I want to tell a quick story about a marketing campaign that Vanguard had run about 5 years ago. And there's one particular ad that we ran when we were experimenting with different messages that always struck me. And we were trying to explain essentially to the firm that created this ad what it meant to be a Vanguard investor. And it wasn't just low cost, it was things like having clear goals, being balanced and diversified, keeping your costs low, being very disciplined, trying to remove the effects of investor behavior. And they came back with an ad, and essentially what it looked like was somebody skydiving, and you could see them, you could see the exhilaration on their face as they essentially jumped out of the plane and get ready to pull that parachute. And it said, some things are meant to be exciting, investing isn't one of them. And they called this Vanguarding. And it always did strike me, because I think it's true in that we think a lot of the things that will really help investors aren't necessarily the most exciting, but we do believe, based on research that we've done, that essentially these simple, what look like simple things, but are actually powerful when implemented, such as, as I said, being very disciplined, diversified, and keeping your costs low, ultimately will serve investors well. We call it our principles for investing success, and we think it aligns well with our mission to take a stand for investors, treat them fair, and give them their best chance for investment success. So that was my presentation. I hope you enjoy it, and I think we have a few more questions. a few more minutes. I'd love to hear any questions. Thank you.
So the microphone are all yours. Yes, sir.
Yeah, hi. I'd like your view on dividend income funds. I glanced through your package and didn't see much on that. Did you have it included somewhere, or what's your take on that?
So I recently published a research. So as part of my role, in addition to doing events like this, I spend the majority of my time writing research papers. And this year, one of my papers was on different types of dividend strategies. Essentially, we were making 2 points when it came to dividends. One would be, the substitution that I mentioned. We don't really view them as a good substitute for high-quality bonds. Ultimately, they're equities, and we think that their risk profile is ultimately equity-like, and so we don't view them as a good substitute for fixed income. The second part of it, though, was looking at the idea that they've actually really outperformed in the historical performance. So we were trying to put that into context and trying to also differentiate different types of dividend strategies. So, you have dividend growth strategies, you have high dividend strategies, and essentially we were looking at their performance through time. A lot of the performance came in the tech stock bear market that I mentioned. That was a market that was really driven by a sell-off in growth type stocks. These stocks tend to be more lower volatility, the high income more value-based, the dividend growth more quality-based. So these are strategies that had done extremely well in that period, and a lot of the outperformance came from that period. We then looked at factors, which is essentially something that came from the academic community. It's been around for about 40 years. Looking at, are there certain systematic factors in the market that explain returns, and essentially through a series of regressions, we were able to prove that about 90 to 95% of the returns was attributed to these factors. So for us, it was trying to break the myth that it's the dividend creating additional return, in that if you think about it, if you have $100 invested in a bond and you receive $5 in interest, then essentially you have $100 in the bond and $5 in your hand. With the dividend, if you have $100 there and it pays a 5% dividend, it's 95 left in the stock and 5 in your hand. So dividends are a distribution of capital, and so because of that, you wouldn't actually expect the return to be positively or negatively impacted by the dividend alone. It's more companies that are either paying high dividends or growing their dividends through time have certain characteristics which have done well in certain market cycles. So it was trying to just shed a bit of light on that. Just people think through dividend strategies, which is something that has gotten a lot of interest in cash flow in the last few years. Just trying to put that in perspective, that it's no free lunch, essentially. There's certain characteristics of those stocks that have done well historically, and if you're investing in them, then we think you need to take a forward-looking view on how they're likely to do going forward. So thank you. Thank you for asking a question about something I recently wrote a research paper about. So those are the easy ones. Any other questions? Yes. Yeah.
So it seems that looking at PE ratios in various lights has a lot of explanatory power. What about the price-to-book ratios of major indices? Do you think they have a lot of explanatory power?
Yeah, so that's another one that has explanatory power, price-to-book. I think it's actually on that chart that I showed you. I didn't go through all of them. It's the reason the Shiller PE ratio is the one that primarily we focus on is because it has 10 years of earnings and adjusted by inflation, and so what that essentially does is it provides a more stable denominator to compare the current price of the market to. So if you look at, for example, a 1-year PE, so the current price of the market by 1-year earnings, you get less explanatory power. So it's also a good measure of valuations. It's just tends to explain a bit less than the Shiller measure, we think, because the Shiller measure tries to smooth out some of. I'll give you an example. A few years ago in Europe, there were very low earnings, and so if you looked at a 1-year measure of the PE ratio or price to book, you would think actually, or I would say price to earnings, you would think that the market was actually really highly valued. If you looked at the 10-year average earnings, you would think the market had low valuation. So you can get different answers, and so we found you tend to get more explanatory power with the more smooth earning measure.
Thank you.
Thank you.
Sir?
I'm curious. My question derives from the previous speaker as opposed to you.
Yeah.
And it relates to the service that we get as investors from financial advisors and the initiative to try to make the financial advisors more responsible to the investors. What's Vanguard's perspective on that? Is Vanguard endorsing that, supporting that, or are you in fact lobbying against the change in standard?
So no, we like the idea. I mean, for us, it's natural. We're owned by our clients, so we do think that people should be held to a standard where they're responsible for acting in their client's best interest. For us, it's natural. Our CEO, who's more engaged on these things than I'm just the research guy. He says we do support the idea of being held to a fiduciary rule. Some of the it's the devil in some of the specifics around that. In terms of how it's done to be most effective, we issued a comment letter where we essentially outlined what we thought would be, most likely to be most efficient and successful there. We could certainly, send that out. If you're interested, it's publicly available. I couldn't do it justice, but essentially, I'm giving you the high level is that we like that idea. We think it's part of our DNA to do that. We just had some specific comments on exactly how it's done.
Thank you.
Yeah, thank you.
Yes, Todd. My question is about the market, basically. You made some comments about you are expecting a correction in the market to more fundamental values. Now, the market in New York has been going further up, and even this morning it's been going up by more than 100 points. And Toronto is lagging behind, and yet the OECD said that Canada will be the highest performing market this year, basically 2017. What's the catalyst that's driving the US market as high as it's doing now? And why is Toronto not doing as well?
So, yeah, great question. So I would go back, before the U.S. election, if you went back to this time last year in the U.S., I'm talking about, there was this idea that we were entering, this period of cyclical stagnation. So in other words, the economy, very low growth, and it could stagnate. And then, there was this view that went the other way, which is that, we had a very pro-growth president. Once Trump was elected, we would essentially, corporate tax reform and infrastructure, a lot of the things that he campaigned on were to be implemented, that would be very, positive for the market. And so we saw this shift. We've always thought, the truth was somewhere in the middle, in that, we viewed the lower growth that we had and continue to have as low but healthier than what we had seen in prior cycles, because investors in the U.S. has essentially deleveraged, and so we weren't as pessimistic as was some different commentary. At the same time, we weren't as optimistic that all of a sudden all these things were going to be put in place that would drive the market and growth really higher. So I talked about the relationship between growth and returns in the long run being low. In the short run, when there's surprises, new information, it can, there can be a relationship by which investors had priced in the idea that we were going to have, much higher growth. Our fear is, people may have gotten a bit, or the investors as a whole may have gotten too optimistic about some of the things that we were likely to see, and that's why when you saw, the markets at, high valuations heading into the election and then the rally since then, again, that's why I say at some point we think there could be a correction. The difference between the U.S. and Canada then would be, in the U.S. we haven't seen, a real shift in the direction of where, some, things like taxes and so forth may go. Valuations are lower in Canada, lower in Europe than they are in the U.S. So, if you looked at the medians of what we might expect, so in other words, the most likely it would be that, markets outside of the U.S. outperform the U.S. market. But we always tie it back to those distributions I showed. Our confidence in that is as good as the measures that essentially go into it, which is maybe, somewhere just shy of 50%. And so, long story short, we think the U.S. markets had a really strong run. And, as I said, we could see a correction there. You hadn't seen the same strong run outside the U.S., and that's why our outlook would be a bit higher there. But we would also caution people not to essentially overuse that information, because it's still a distribution. Thank you.
I have a question about the slide where you're talking about the role of fixed income and high-quality bonds during particularly severe market downturns. My question is...
we don't hear you very well. Could you speak at the microphone? Thank you.
Go back to that slide.
Sorry. My question is on the issue of the Canadian corporate investment grade bonds. I think the chart shows it's really the next best thing to government bonds. But in particular with that category of corporate bonds, are the doomsday callable corporate bonds, how do they fit into that classification of high versus low quality bonds?
Yeah, so essentially if a bond is rated BB, B or better, it's investment grade. And so, that when we say high quality, that's what we mean. It has an investment grade rating. What you see is actually government bonds tend to have the strongest relationship to negative equity returns. The reason is because essentially when equities are falling, two things happen. One, you typically see easing of monetary policy. So in other words, you see, fall in the discount rate. And then also a flight to quality effect, where essentially people buy the safest assets they can. And high quality government bonds certainly fit that. So that's why you see the most significant, rebound, if you will, in high-quality government bonds. But corporate bonds would be the next best. They're also, high quality, but they don't have the same flight to quality effects, and you also don't have as clear of a negative relationship with falling interest rates because there's a corporate spread there as well. So with government bonds, you get just, essentially the pure duration, if you will, relationship. With corporate bonds, it's the duration plus the corporate spread, and that's why, corporate spreads essentially usually widen in equity downturns, and that's why the relationship isn't as strong, although it's kind of the next best thing, as you point out.
Does the doomsday callable have any impact on what you're saying?
Doomsday callable.
Right.
I hadn't heard of that. What essentially?
I just remember buying a couple. They were basically investment grade corporate, but when I called the firm, they were basically saying it's if there's a change of ownership before they come due.
Yeah, my sense is I have to apologize. I hadn't specifically looked at those, but my sense is they would follow a similar trend to what's shown on the chart anyway, and that you wouldn't get the same relationship you would with government bonds. But I don't know essentially if they would be slightly better or worse than broad market corporates. I would
Thank you.
apologize. Thank you for the question.
Yeah, my question is related to the dividends, high dividends paid by some companies. I noticed that some of those companies have high payout ratios,
Right.
more than 100%. I understand that means they are giving out dividends from their capital, or is it not a little bit risky to invest in those type of companies?
So I would say that the way when you say risky, we view it as equities, high dividend paying stocks being equities. About 80% of the return you can explain by just the market return. The higher payout, what's interesting is if you look at all the stocks in the market, and you rank them by dividend yield. So you look at then the top quartile dividend yielders and the bottom, you look at their returns, they're almost identical. And the only difference is for the high dividend yielders, a big portion of the return is coming in dividends. For the low dividend yielders, almost all the return is coming in terms of capital appreciation. So I mentioned earlier this paper I'd written with some co-authors on dividend strategies, and one of the things we were trying to do is break the myth that dividends are an added on sort of wealth creation. The payout ratio we also looked at. I would tie that more to dividend growth, more the opposite of what you're saying, not the very high yielders, but the lower yielders. And the dividend growth stocks tend to have lower yields than the market because their payout ratios tend to be relatively low. The reason is, of course, they're growing their dividend through time, so you can't pay it all out at once. That tends to give you more of a quality bias in the portfolio. So that's the closest thing I would have to relate to the payout ratio. What I would say about the high dividend stocks is, we wouldn't expect the payout or the yield to necessarily significantly impact the return, other than, if it gave you exposure to more value type companies, your returns would be more correlated with that. That was essentially this regression work that I was mentioning.
So we are on a time schedule, so we'll take one more, and if it's quick and short.
I was just wondering, they say that they're in U.S. funds. What would that differ from Canadian?
So we would expect the conclusions of the work that I was talking about to hold up for, Canadian investors. The work that I'm referencing, we had looked at global. We looked at global data, so essentially developed market equities for the higher yielding dividends. For the dividend growth, we had looked at the U.S. Market primarily because it had the longest history. So in Canada, in the UK, different markets that we cover, there's a shorter window of performance, and so we tried to use this this longer series that we had in the U.S., but we would expect the conclusions theoretically to play out. And I would actually say a lot of the work that I was mentioning around the high versus low dividend, I had originally, we had done a lot of work in the U.S. on, but also the U.K. And I can tell you those relationships hold there as well. So thank you very much. I think we're out of time for your questions and for having us. And I'll be around as long as Satwick from our institutional team, and happy to chat. And again, thanks for having us.
Thank you, Scott.